Hi guys, this is Terry with Futures IO. It is my honor to welcome Anthony Drager of MarketDelta for today's webinar, Execute with Intermarket Correlations and Order Flow. If you have questions, you can type them into the questions box and we'll do our best to answer them at the end of the event. There will also be a book giveaway after the Q&A, so pay attention, take some notes, and see if you can answer the 5 questions from Anthony. We are giving away 5 copies of Switch, How to Change Things When Change is Hard by Chip Heath. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. Also, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. Don't forget, you can also follow us on Twitter at FuturesIO. Without further delay, I'll hand it over to Anthony.
All right, Terry, thanks. Let me show my screen real quick. You guys should be able to see my screen.
Yep, looks good.
Right now. All right. Thanks, Terry. All right, so let's get rolling here. This isn't going to be a very long webinar. Won't be sleepy, I can guarantee you that. In the next half hour, I'm going to show you, explain some things about signals and things you've used your whole life, but maybe not in trading. Maybe some of you do use it, maybe some of you don't. I'll first give you the quickest bio ever so you know a little bit more about me. I'm not going to bore you to death, the history of what I've done. I will get into the why, the question of why markets do what they do. We'll cover order flow and the main question you have to ask when trying to read it. We'll do it with a little levity, what I call a baby bird story, and punch a guy in the face, give you guys a sense of what and how markets move, and then we'll go on to market relationships again with some stories about how you guys buy and sell cars, find the leader, trade the lagger, and then as Terry said, at the end we'll do a Q&A and he'll do the free book giveaway. So quickly, how did I start? I started originally on the trading floor at the CME as a clerk. Took training classes to become a pit trader, became a member of the Chicago Board of Trade and a pit trader thereafter. Couldn't make any money in the pit. I was in a very illiquid pit. Back in 1999, 2000, there was whispers of this thing called electronic trading, and they were going to take this business into or off the floor and on a computer screen. So I found an office that was doing it electronically called a prop firm. Now, you might ask, some of you guys know, some of you guys don't know what a proprietary firm is. Most don't. And you should. I didn't know what it was, however, in 2000 when I meet with this guy and he says, well, here's what we do. We take you, we put you around guys that do this for a living, that trade, there's training, give you a workstation, monitor, things like that, and a percentage split's worked out. If you make money, we get half and you get half. If you don't make money, they'll fire you eventually, but it's their money you lose and not your own. It's typically the deal in most prop firms. Now, you don't find a lot of prop firms in Little Rock, Arkansas, or the middle of Texas, but in Chicago, there's dozens and dozens in and around the city. This was one, and in April 2000, I had the opportunity to get an interview and get a job with one. But I asked, do I want this job? So I go to my dad, who's always been influential in my career and my background. I said, you know, what should I do? And he says, well, when you go back for the interview, if the cars in the parking lot are nice, take the job. They're making money. Pretty ingenious and simple advice. So I went there. Cars were nice. I wanted the job. I do the interview. And the owner gave the interview. He was also a former pit trader. So he kind of took a liking to me. And he said, the last question he asked me, and I knew it was important because he waited to the end, what makes you think you could do this? And this is a question you guys have to ask yourself all the time. And I guessed at it. It happened to be the right answer. The answer was because I'm putting myself around guys doing it, and I think that's going to lead to my success. So he said, that's it. I'm waiting for the slide to move on. There's probably a delay with the slides coming in. So he goes, that's it. He goes, in order to turn the corner and have light bulb moments, you have to put yourself not just around guys doing it, but around guys that are trying to do it. And you'll be happy to give 50% of your profit for 3 years because it'll take you a lot longer if you ever get there if you try to do it on your own. And a lot of you guys are home-based traders. You know it becomes a very lonely business pretty quickly. So I got the job. lo and behold. And I started doing well from the first day and the first week forward. And I started, this is a picture of my family here, and I'm going to tell you why in a second. But I went from failing and making no money in the pit to making more money than my dad, and I was home at 11 o'clock in the morning because we were trading European futures. Back then, those were pretty much the only instruments online and electronic. So we started around 6:30 Central, and we were done by 10:30, 11. That was the second half of the European business day. But it always dawned on me when learning. Now, I kind of knew how to trade. I was just now put in front of markets that were liquid and opportunistic. I wasn't in that in the pit. But it always dawned on me when trying to learn the right way to do something. My dad, who's on the left, that's me on the right, my brother's in the middle. He'd always tell us, you guys have seen my other webinars, I always try to show this picture in this slide. If you know how, you'll have a job. But if you know why, you'll be the boss. He always told my brothers and I this growing up. And I think in trading, if you only know how, all you'll end up doing is donating. You have to at some point know why markets do what they do. What's the incentive to make markets go up or down? So just so you know, this is my workstation. That's me in front of it. That's me without being in front of it. You don't have to have an elaborate workstation like this. I just think that you need more than a postage stamp laptop that a lot of people try to trade on. So you need something more than, one or two monitors. So what is your step one? I'm going to make this as intriguing as possible for you guys to kind of follow. There's all these missing pieces of a puzzle, let alone trying to put it all together. And, the first thing is usually the most elusive in your journey in trying to get to do this successfully, but then also stay successful. It's one thing to get successful, it's another thing to stay successful. What makes you pick up your gun? If you're hunting deer, you're not just walking around all the time. If you're sitting there and you're waiting, what makes you pick up your gun and get ready? What makes you sit up in your chair and kind of run through that ready, aim, fire progression? So usually what's missing in most traders, from what I've found, is no matter if you're looking and trading currencies, if you're trading interest rates, if you're trading straight fundamentals, what's usually missing isn't support resistance. Most people will come up with decent support and resistance lines to want to trade off of. And it's not your understanding of profiling. I think profile has become really important, TPO, volume profiling in this industry lately. A lot of people understand market structure a little bit better. But that's not even it. Very frustrating thing about understanding profiling is, while it helps you create an opinion, it's very weak at executing that opinion. So what's missing? It's the execution using order flow and market relationships. And it shouldn't be foreign to you because you've used it your whole life valuing price. So let's go into the first story, the baby bird story. Some of you guys have heard this. If you've heard me give webinars, you probably have. But most people donate in this business. Most people who try to trade fail at it and become very helpless, like baby birds are in a nest. Well, what does that mean? Well, if you think of helpless birds in a nest as non-professionals or retail traders, and the price of a market is mommy bird trying to feed you and maybe fill your order, that's the price. And all of a sudden, when you're about to get filled for a winner or to get out of a winner or to have that great trade, all of a sudden a hawk comes, rips mommy bird's head off, and mommy bird is gone. So is the market, so is the price. And you're left helpless with a loser. Couldn't get out of a winner, chase the market. How do you become the pro, which is the predator and not the prey? This is why markets move, stop, go away. And the true and the best support resistance is going to be through a story like this. I'll throw a chart up and kind of give you an idea of what I mean. And I can't see anybody's questions or comments. And so wait till the end. So I'd be happy to read off some questions and we'll go through them. But if you look at just a normal candlestick chart and you just try to visualize, this is what I do when I look at a chart. I don't actually draw these rectangles or boxes, but visually I look at trying to find out where the hole in the boxes might be, and the market runs out and runs through them, right? So you could all draw these consolidation boxes all up and down a market and kind of understand where the fights are in a particular market. Now, this is kind of just simple stuff, but remember this about trading. The simple and basic techniques are also the advanced techniques. And the reason why the basic techniques and concepts are also the advanced technique is because everyone jumps over this stuff. And if they ever get around to finding the best way that's going to give them a chance to get and stay successful, it's usually when they've been in the store a while. They've been in the market a while, and they've been through indicators, and they've been through green light, red light stuff. And it's not your fault, it's not their fault. You don't know what you don't know. So anyhow, you got these consolidation boxes, right? Well, let's just say a bunch of these baby helpless birds get short. What happens after you get short? You have to cover that position, right? You're a buyer to cover a short. Well, when the market runs away from you, let me pull a pen up here. When the market runs away from all these shorts, they're all stuck, right? And now it's in here. What happens when the market potentially comes back to let you out of a loser? What do you think all these helpless baby birds are doing? They're all trying to do what? To buy it, to cover that losing position, so they don't have to take that heat anymore. Or they can get out for a scratch or a break even or a break even plus one. And they come in and they're like, they took all this heat and they're all trying to get out, and so they're all these birds that are buyers. That's going to be your best support, by the way, is when you can accurately assume where people are stuck short in a position from a clustered area of prices. Because you're going to have all these birds in here trying to buy a cover and a short, and they don't get filled, and that's like the hawk taking the mommy bird away or taking the price away, and then these birds chase it up. That's the dynamic of why support would work, period. It's not no mathematical formula. It's not a pivot. It's not a stochastic. It's not a moving average that crosses a Fibonacci. It's the dynamic of shorts, and a lot of them trying to cover a trade that they took a lot of heat on. So I think that if you don't really take anything from this webinar that you're watching, remember this top line. It's not where a market's price is going, it's when. Everyone gets into this business and wants to know where price is going. Where's it going? Where's it going? How can I predict where it's going? It doesn't matter. What matters is when. You'll make money if you're good at the when. You'll be very frustrated if you're only good at the where. And most people try to learn this business backwards. They want to learn where it's going before they understand when. And before they're able to understand the weakness that we all have, and that's execution. No matter if you're a retail trader, never made a dollar, or been a professional for 16 years, April of 2000 is when I was hired, like myself, when I'm not trading well, I'm not executing well. The difference is I know how to execute, and those who've never made money never learn the right ways to execute. So when is what's important. And it brings me back to the owner of the prop firm. He used to say, it's not about being right. That's the other thing retail traders want. They want to be right. It's not about being right. Making money is all that matters. You could be wrong and make money. You could be right and lose money. The other thing he said that always resonated with me, and it had me come up with this saying that I'm gonna talk about in a second. He goes, remember, you have to buy it after you sell it. It might not even been him that said it. It was someone in the office that said it. You got to cover that position, which is what I was trying to tell you earlier. So I come up after you buy it, you're a seller. And that's resonated with a lot of people, and the reason is because you never think about most people that hear this saying for the first time never thought of it that way. After you buy it to get long, you have to cover it. After you get short, you have to buy it to cover that short. So after you buy it to get long, you're a seller. After you sell it to get short, you're a buyer. Getting out is where opportunities are. Getting out is where you're going to find turns in the market, because it's going to be where you find the emotion of people that have to exit. And it's going to answer the question, when is the market potentially going to move? So where could possible emotion be? Let's say someone's selling their house and they're a couple that hates each other. They're getting divorced. Where's the price of that house probably going to go if you know that? They have to get out. It's probably going down. That's good information to know, because you know there's emotion involved in this dynamic. So your job is to find where those divorce couples are on a chart. I'll give you another example with this after you buy it, you're a seller. Say the E-minis are trading at this black line in the sand. You want to get long. But unbeknownst to you, you're a buyer, and so is a lot of other people trying to get long at this particular line in the sand. And all the market does after you get long is go down. We've all had those trades, right? Effortlessly goes against you. You feel like crap. You wish you never did it. And all of a sudden the market starts coming back for you. I guarantee you, whether you try to sell it or not, the inclination is to get the hell out of that long position, which makes you and everybody else a seller. And if there's a lot of sellers, price isn't going to go through there, is it? It's going to come off and go away. This is your best example for resistance. The fact that you get all these, I'll put a pen on this. The fact that you get all this interest of people that want to open up long positions, and all they did was take heat. So the inclination is, man, I'll never do this again. Just let me out. A lot of them get a little greedy, want to make a little money on it because they took the heat, and those are the ones that end up selling it way down in here. People who have to get out are going to create the best support, in this case resistance. I added, again, that exit sign. Also remember this quote, profits come from other traders' losses. So it behooves you to see where people are stuck, where they're trapped. So another story, punch a guy in the face. So I'm going to show you a how I filter out bigger orders and try to qualify an idea. Punch a guy in the face. You ever get punched in the face? I have. It hurts. Did you ever try to punch a guy in the face? I have. Sometimes that hurts. Well, if you ever punch a guy in the face and he doesn't flinch, what's going to happen next? For me, I'm running the other way. When I was young, I used to hang around and get my butt kicked. Now I'm running the other way. That's the clue, the punch in the face moments that you're trying to look for on a chart or on a price ladder. When the market doesn't do what it was supposed to do. This guy was at least supposed to flinch and maybe go down, and he doesn't. That's a clue. You have to find out if there's going to be an exit. Back to that saying, it's not where price is going, it's when. So here's what we call the footprint filter. And just look at this. Don't worry about all the X's and O's. Just understand that up in here, a big buyer showed up. Lifted the market, and it didn't go up. The next right side of the market is most likely down. That's not obviously 100%. Hey, as you see a big green buyer come in and price doesn't go up, sell it. Of course not. But it's a clue that something didn't happen and it was supposed to. Well, you have to know what's supposed to happen first before you're going to know what should have happened and didn't. Most people in this business, when they try to learn, if they ever get to this concept, they want to buy with buyers and sell with sellers. BS, you don't want to do that. You want to buy when people sell it and it can't go down. You want to sell it, not when people buy it, but when people buy it and it doesn't go up. Because what should happen when you get a lot of buyers in the price of anything? It should go up, right? A lot of people want to buy it, price should go higher and higher, just basic laws of supply and demand. So when a big buyer comes in, aggressively lifts an offer, and price staggers, and you're bearish anyways, that's your when moment. That's your qualifier. That's the tool or the skill that you need in order to get and stay consistent pulling money out of the market in this business. It ain't going to be a red arrow that goes up that's always going to work. It's not going to be a green arrow. It's not going to be some sort of ability to be an expert in reading the profile or having a few paths of least resistance and have a plan that, you know, a lot of times people have too many plans or they have too many ideas and they have a plan that if the market doesn't follow that plan, then what, right? You're trading and engaged in something that's always adjusting. As someone that's trading it, you have to adjust also. it should make sense why this would be a good qualifier. Punch a guy in the face and he doesn't flinch. I'm running the other way. Where does the market going to run the other way? I got news for you. If this big buyer comes in and you say, well, then I'm going to buy it because it's going to go up, it's already gone. That premium is already there. It's already come and gone. You got to always think the opposite of conventional wisdom. That's what works in this business. If you're wrong a lot in most other industries, most other businesses, it's catastrophic. You're supposed to be wrong in trading. You can't get the winners unless you take the losers. Losers are like marketing expenses, right? If you're in business, you're going to have a marketing expense. You're going to have an expense for employees and things like that, for office. Don't try to avoid losers. Just try to be consistent in whatever you're trying to do and have someone make you accountable for that. So I didn't add this any big orders, but that's the question you got to ask. Not just where are the big orders that are coming in, but how is the market reacting? Again, after you buy it, you're a seller. So is everybody else. There's the selling as the market goes down. So another example. This is Apple. All right. Trading is trading. First of all, the chart that you're looking at is a point and figure. So forget about time frame and what a point and figure is. Just look at this line I'm drawing. That's how the market in this particular case is moving. If a bird in the sky left a trail, what would it look like? That's the paradisities I use for my instruments. What you see up here is a lot of big shares being bought in this particular stock, which is Apple. Price obviously can't go up. Now you don't know, and I know that price is going to go down. I do know that it's having trouble going up, and usually it flies higher when it's that kind of buying, when it's that much buying activity in a certain cluster. Usually price could fly higher. It's not. Shouldn't that get you to scratch your head? Of course it does. Now, there's another advantage or edge that comes with this concept of reading order flow correctly. And you could read order flow on a dome, and it's a whole nother webinar and not another skill set, because there is a lot of value in what you see in a price ladder. Just talking in simplistic terms, because trust me, simple is where you want to be. You want to be an expert in simplicity. When I get into market relationships in a moment, I'll tell you how that's your best edge. So here, first off, price can't go up, it goes down. So let's say you missed that leg lower. It's usually great near-term resistance afterwards. For the same reason that I showed you that baby bird chart. If you had a lot of people buying it here, market goes down against them. As soon as it comes back up, they're all trying to do what? All these purple X's up in here are sellers, potentially trying to cover losing long positions. Again, that's going to be your best resistance that you'll ever be able to find or pull out. The last part of this order flow, or the last kind of phase of order flow, there's a lot more you can learn and should learn on a price ladder and whatnot, but absorption, what does that mean? Well, I'll give you an example. Let's say there's a cul-de-sac with a bunch of houses. They're all for sale. Where should price go? Down, correct? If all these houses are in one cul-de-sac and are all for sale, price should go down. But it's not. And you find out one guy is buying all these houses. And you find out that there's oil underneath this property. Where's price then going? Up. It's got to get you to scratch your head when you see what should happen not happening. So how do we kind of relay or reapply that into a kind of a real life scenario. Just look at this chart, top half and bottom half. The top half is price, the bottom half is delta. You don't have to be an expert in delta, know what it means, and everything else. It's just the difference between two things. The difference between aggressive buyers and sellers is this chart on the bottom. Let me get a pen here. Up in here is price. It doesn't matter what it's the price of. It's moving up, it's moving down, it's moving up, it's moving down. That's the pattern, right? What's delta doing? Delta has moved down significantly down in here. What's interesting about buyers and sellers is they tend to drive price up if there's a lot of buyers and down if there's a lot of sellers. So there's no clue to when it does what it's supposed to do. The clue is when it stops doing what it's supposed to do. So for instance, erase those drawings. You see this consolidation in the delta between buyers and sellers, and you see how a lot of sellers come in right here and fires it lower. This is a chart of what the delta is. See how it fires it lower right there? Well, then come and look at price at the same time. While it comes lower, it doesn't breach its previous low. And yet, this low gets taken out. This low doesn't. It's a very simplistic example, but that's what I want to create in this webinar, some very, very simplistic and basic ideas, because the right basic ideas, like I said before, are also the advanced ideas, period. You see the discrepancy? Usually delta and price follow each other. There's no lead, no lag. They're usually together, so there's no clue when they're charting alike. But when all of a sudden the delta goes down like it does right there in my illustration and price doesn't, wow, you could be absorbing a lot of sellers, and after you sell it, you're a buyer, right? There's oil underneath there. Qualifiers. Using order flow as a qualifier to address the number one weakness everybody has, and that is execution. Doesn't matter. Execution's everybody's weakness. Some people will try to solve it with their psychology and their psychiatrist and psychological books. Great. But you got to know what you're doing in order for the psychology to work. Mastering your psychology is not going to make you a profitable trader. You got to know what you're doing first. Like a surgeon. Do you want a surgeon who's really, really, knows what he's doing? Or when you're getting operated on, do you want him to have to do breathing exercises to calm himself down and get into a Zen-like state? Or do you want him to know what the hell he's doing? Yeah, the psychology could help you, but you got to know what the heck you're doing and how you're going to react in a very subjective and emotional environment. There's two things, and I didn't put this as part of the webinar or in any slides, but there's two things, there's almost two steps that you have to get on in order to go to that third step. Number one, you have to at some point, first step is you have to at some point find the right concepts to understand. And then number two, you have to be good at implementing those concepts in a real life, emotional, subjective environment. Most people don't even get to step one or two, even though they think they're on their way. They never even got to these two. They never found the right ways to trade, let alone how difficult it is to actually implement what you learn. It's like Texas Hold'em. How many people were great Texas Hold'em card player, poker players because they read a book on how to do it? And it's not knowing the principles of playing great poker. It's being able to implement them when the chips are on the table. Trading isn't much different. Only the right concepts are more elusive than they are in trying to play poker. You could find the right ways to play good poker in books and everything else. In trading, there's a lot of distractions. You do an internet search and you get inundated with everybody who's an expert. And by the way, I'm not an expert. While I might be a pro, I'm not an expert. In trading, you don't want to be an expert. If you want to be an expert, I tell people, go become a chemist or a doctor or an engineer. You want to give yourself the best chance at pulling money out of the market and call this a living? Be good at valuing price. Experts aren't wrong that much. Great traders are. We're just good at getting out of losing trades. And sometimes we could take being wrong and turn it into money because our locations are not always precise, but are consistent. We consistently put ourselves in positions to not get our face ripped off when we are wrong. And we have a plan about knowing where the hell to get out before we get in. All right, so let's move along to the second of this two-prong approach, order flow and market relationships. How do you find value in the price of something when you buy or sell it? Let's say you're going to buy a car. When was the last time you bought a car? Did you bring a Fibonacci, a stochastic, Bollinger Band, a TPO profile chart into the car dealership to negotiate price? And hey, buddy, price is too expensive. It's above the 618. See these stochastics? They're above 75, man. It's overbought. Of course you didn't do that. What you did is compared dealership to dealership to find value. You went online and looked up everywhere you could to compare and contrast. It's the only way price is going to move or understand if it's cheap or expensive, and how you can get a car salesman and a dealership to move their price is by having this as part of your negotiation, knowing if it's cheap or expensive based on who the hell's selling the other car down the street. So let me give you this simple video. I'll give you an example for today. Keep it simplistic, and then we'll just go into some Q&A. Like I said, I don't go on for an hour or hours when I do these presentations. I think attention spans are pretty short. I know mine is. I stopped listening to myself about 25 minutes ago. But you know, you can only absorb so much in this day and age, and that's why Terry and Futures.io are recording it, which is cool. You can go back and watch it. But let me show you this short video of the 30-year bond and the ES. So stocks and bonds are often, not always, but often opposite. It's called asset allocation. You know, when people want to keep their money safe, they sell stocks and they buy bonds because bonds are, you know, said to be a little safer. So when you sell stocks, what do you do with that money? You buy bonds, and then you sell bonds, you buy stocks. So the opposite or inverted relationship between these two could often help you find, again, when moments by comparing and contrasting. You notice how I didn't talk about how to get bullish or bearish? You'll find out and get good at that by default. Don't learn that first, learn that last. It's so easy to create an opinion. Do that last. Do that last. Because you could be dead right, think it's going down, and you can't make any money because you don't know when. So let me show this video. I think it'll play. Let's blow it up. Let me do this. Bring you guys into it a little bit. Make it a little bigger here. So here on the left is the stock index. It happens to be the E-minis, right? The ES. On the right is the 30-year bond. Now we're looking for an inverted relationship. I paused it. If I'm bullish and I see this, I know when to fire in the ready, aim, fire. So if you're bullish and the market's getting in, there's maybe some support. You sit up in your chair, you're ready. You see the bonds, make a move, you aim, and you fire. You know that progression. Let me play it again. Watch the bonds here on the right. They're going to shoot lower right there. You see them shoot lower? I pause it again. This is when, if you are bullish, your when moment to buy it when this relationship is actually working. And there's a big move in that correlation. Keep it simple. Now watch that circle. You see the ES. It lagged a little bit and then got excited and went up. I'll play it again. Watch on the right. Bonds shoot lower right there. You got all this time to buy 2 quarters, 3 evens. It goes 4 even, 5 even, 6 even. Bonds continue to go down. You could stay comfortable in a long position you just opened. I remember talking about this with one guy, and he goes, "That's it?" Sometimes I go, "That's it." He goes, "Really, that's it?" And I go, "That's it." He goes, "That's it?" And I said, "That's it." I said, we're playing tennis with the words, "That's it." I said, "Don't overthink it." Now, this doesn't work all the time and isn't that simplistic, but you got to understand that find the leader, trade the lagger is the edge that you're looking for. You could throw all your other books and everything else out in the dumpster or out in the garbage can, put it out on the curb, let the garbage man read those books and open up a trading account and you trade against them. Market relationships, when you find a good correlation, sometimes all you need. Now there isn't that simple lead lag. I don't want to make it seem like you can go find. Sometimes there is though, and it's not always the same market. Like the bonds are a little positively correlated with stocks today. Usually when there's fear in the market, this inverted correlation works really, really well. So that's another thing. I'm going to leave it on this screen and talk for a second. Fundamentals. I know a lot of people are going to be watching this on replay at some point in the future, but it's August 16th, 2016. This morning we had a Fed official, Dudley, who's a FOMC voter for U.S. Central Bank, Federal Reserve, was hawkish, meaning he was more prone to see higher rates this year. He had said it looks like they could raise rates at the next meeting. Well, the Fed fund futures and investors and traders don't really haven't priced anything in for a rate hike at the next meeting. He's typically a dove and he sounds hawkish. That's bearish for stocks. It shouldn't take you that long to understand that. If indeed the Fed were to raise rates, markets are kind of caught off guard. They're near all-time highs. They don't kind of like that. So it created a little weakness early on this morning. It was around 7:30 Central today. So we went down a little bit, then we opened up at 8:30, and we went down a little bit more. So that's a market relationship. Now, it's not with another instrument, but it's with fundamentals, right? So you got to know how to act and react to what really drives the market, because you could be the most astute profiler in the world, but if you don't know some of these things I'm talking about, you'll never turn that into consistent profits. You'll actually be frustrated because a lot of profile stuff, which is good, and I would always encourage people to learn a little bit about volume and TPO profiling. I think it's important. I think it teaches you a lot about auction market theory. But where it's frustrating is where it gives you a good opinion as to where the market, it doesn't give you a when the market's going to go. Well, where do I get long? Okay, I'm bullish. That's great. Now what? I buy it here, wouldn't just close my eyes and risk a whole lot to make a little, risk a lot to make a lot? How long am I in the trade for? When do I know I'm wrong? Maybe the profile bias changed to bearish and I'm underwater. All that kind of stuff. So you got to drill down off of that. The other thing about auction market theory is learn how an auction works. I could go to a live auction and be better than the auctioneer that's there, because I've watched an auction my whole life trading, and my auction goes up, down, sideways, down, down, up, down, sideways, up, down, right? Their market just goes straight up. Their job is easy. And I say that kiddingly, but it's if you can't follow, if you can't quote a market, then you can't follow it. If you can't follow it, you can't trade it. And it has nothing to do with time frame either. So it doesn't matter my time frame as to can these concepts help your time frame. Of course. There's always something that you have to know how short time frame guys think, even if you're a swing trader or position trader. As a smaller time frame day trader that I've always been, it's always helpful to know what larger time frame guys are thinking. But it's really imperative for longer time frame guys to have an idea what short time frame guys are doing, because you have to get on the ground and execute in real time. And short time frame guys have a lot of influence on short time frame price movement. Hopefully this makes sense in a very simplistic way. Like I said before, and I write this in my office on my whiteboard, is expert in simplicity. So if I'm not getting it, I go back to simple. You have to have a few things to line up to put a trade on, but not 10 things. Maybe more than one, but not 10. Because you'll never trade, and then when you finally get 8, 9 things to line up and you pull the trigger and the damn thing doesn't work, who's going to be really mad? You finally got all your things to line up. They all got to make sense, and they've got to be things that you use to value price when you buy and sell T-shirts and houses and cars and anything with a price attached to it. And I don't discourage people from understanding Fibonacci and stochastics and profiling. All that's great. But they're not used when you find the value of price in the real world, and they're not going to be more important than influences of other markets and buyers and sellers, and when you could find where people are stuck. Hopefully this resonates with a lot of people. It could be fundamental, it could be relationships with like big economic numbers that come out. Non-farm payrolls, the biggest number of the month, always has been since I've been in this business. 1991 I started on the floor, 96 I got back on the floor after college, and that number was always the biggest number of the month. How does the market react to it? It's a bullish number. Did it go up? Did it stay up? Because that kicked us up the last two reports and kept us on an upward trajectory in the E-minis for days and weeks later, the July release and the August release. Let me show you some charts from today, and then we'll wrap it up and do the Q&A and give away some of these books. And I'll tell you more about this book in a second. It has nothing to do with trading, but it has everything to do with making decisions, which is what trading is about, right? So let me bring up my charts. You guys should be able to see. This is the E-minis, the ES. It's a footprint, but I'm not here to tell you what these numbers mean or the periodicity and the rotation of them. Just remember, like I said, if you're watching a market, it's like watching a bird in the sky. The price is the bird. Where he came from is the trail, and that's what you want to see. You want to see where it's making highs, lows, different things like that. All right, let's get rid of it. So this is the E-minis. Today, after the market sold off, and I talk about losing trades more than I talk about winning trades. I think that's important. Your typical guru out there, and I'm not that, or expert, wants to talk about winners so your eyes get real big. Listen, you're going to learn more from talking through losers than winners. I know that's not the sex appeal of trying to learn this business, but that's what it is. So when you go back to, sometimes you have great trades, you don't get filled. My two worst trades were non-trades because I didn't get filled, but I tricked my mind so I don't get too upset. I was trying to sell it here and I didn't get filled, and try to sell it back here, I didn't get filled. But I'm not going to talk about those. I pretended like I caught them so I didn't do anything stupid. This is this morning, by the way. So we open up at this yellow line. We kind of come down, and I'm not super bearish, but I'm kind of bearish in here, and I'm not really looking to do anything. And then all of a sudden, actually it was right before this happened, all of a sudden, I'm more bearish than bullish in this particular moment. And then all of a sudden, on the right side, I blew up this chart a little bit so you guys could see it, is a chart of the biotech sector. Now, it's not every uptick and downtick am I watching this biotech sector, which is the XBI, but watch it. It's a heavily weighted sector within the index, right? So if the biotechs are real strong and you're real bearish in the E-minis, be careful. This is an important sector. Well, all of a sudden, in the corner of my eye, this thing kind of gets stepped on and breaks. Where was it? It was more in here. It broke from like 63.15, broke about 20 cents. Pretty good move in the short amount of time it did it, right? That got me to hit the S&Ps and kind of execute the bearishness I had. We were back to the open, and I thought, if I had something to kick my rear end in, I'd take a shot. And it was this move where my cursor is. I'll put a pen on it to help you guys. So it broke pretty quick from there to here. And it got me in a decent spot. Now, the reason why I'm bringing it up is because the definition of a good location is the market going your way ASAP, whatever your time frame. Because it's a lot easier to now manage and be objective when you got a little head start, right? And the faster a price or a trade goes your way, the more objective, the faster you're going to get objective. You're going to get objective quicker. Make sense? Now, my plan, and this was most important, if it didn't go down pretty quickly, I was going to try to get out as close to where I got in, or worst case scenario, right above these highs. That was my initial risk. But I don't want to always have to take my initial risk as my average risk. So your initial stop, which is usually what people use to get out of losers, doesn't always have to be your average loss. And that could be a whole nother webinar. The point is that market relationship got me in. There were some other things that got me bearish based on some of those comments I talked about fundamentally, the fact I thought that they could maybe defend the open, but I wanted to take my rear end in, and that was the last condition that had me sell it. And then it's important to watch what got you in, and is it still doing what got you in? So if I sell it because the biotech sector got hit, is it still getting hit? Because if it bounces right away, then I'm like, oh, shoot, right? So you got to make sure your correlations are helping you with maybe a slight lead lag. Sometimes it's the biotechs. Sometimes it's the energy sector. Sometimes it's crude oil. Every Wednesday, which is tomorrow at 9:30 Central, there's an inventory number that moves crude oil mostly, most of the releases. That's the biggest number for oil, and it comes out every Wednesday at 9:30 Central. Well, oil influences stocks when oil moves a lot. Why? Because there's a lot of oil companies in the index. Because the energy sector, I think, is the number 2 weighted sector within the index. If oil rallies $1 out of nowhere, I don't want to be short the E-minis. And if I am, I'm getting the hell out. So you got to be aware of what's going on around you. Whether you automate your strategy and you're really mechanical or not, because you're trading something that's not scientific. You're trading something that has a lot of art and emotion to it. So it's not always going to make sense. You have to make sense when it doesn't make sense. You have to find that those are the clues as to what's going to help you get short, get long. Don't be too mechanical. You don't have to be real discretionary, but you can't be too mechanical because you're trading something that's not super mechanical. I tell people who are engineers, I said, you got to be exact when you're an engineer or the building falls down. If you're exact, if you try to be exact as a trader, you'll fall down. And don't think you're going to understand everything from anyone early on in trying to learn. Now, some of you guys are on different levels of your learning. Some of you guys are probably real skeptical about trying to educate yourself because you see out there's a lot of crap. Well, there's a lot of bad doctors and lawyers. There's a lot of crap in everything. Most people stink of what they do. I got news for you. I don't blame you for being skeptical. But you have to understand that at some point you hope someone's helping with the right stuff, or else how are you going to learn the right stuff, right? And don't think you're going to understand everything in a day or in a webinar or in a book, because you think you're going to grab the knife from a surgeon after 1 or 2 days of observing and saying, hey, let me cut the guy open tomorrow. I think I've seen enough. No, you're not going to understand it. You got to ask questions, and you got to get yourself in a position to know what's around you, and that's ancillaries and correlated markets. So Terry, if you want to open the mic back up, ask some questions, we'll knock them out, and then you can do your book giveaway and go from there.
Okay, let's see what questions we have.
I added, and Terry will give you guys this, there's weekly meetings I do, and I made one from private to public. If you have the link, Terry will give it to you later. Go and watch it. It's called What's Your Step 1? I talked a little bit about a step 1, when to pick up your gun, that whole ready, aim, fire progression. It's like a 45-minute video. Watch it if you guys want. He'll send it out at some point in the chat. But go ahead, Terry.
Okay, let's see. When you were discussing Delta earlier, can you explain that a little bit more?
Yeah, so Delta is the difference between aggressive buyers and sellers. So when there's trading on the offer, they're considered buyers, and when there's trading on the bid, they're considered sellers. And you take the difference, you could chart that difference. So if I were to go and say, let me pull up my Prezi again. Here it is. So if you were to say a lot of people came in, what happens when you sell the market aggressively? You put in a sell market order, right, Terry? And you hit the bid. You would be contributing to the delta in a negative way. So let's say Terry sells 5 contracts, just for example's sake, aggressively hitting the bid, and I buy 1 S&P, aggressively lifting the offer. The delta would be -4. Make sense? Terry's 5, and then my 1. Therefore, there's a lot more selling than buying. Where should price probably go? Just in a vacuum. Should go down, correct? So the whole theory is if you get a lot of selling, like in this chart right in here, and price doesn't go down, that should be a head scratch moment that it's getting absorbed and it might bounce. That's all. Hopefully that answers this question.
Okay, let's see. When delta and price diverge, is this an indication the price direction is not well supported and the market may be getting ready to turn?
Yes, but here's the dynamic, because there's a lot of selling and potentially the assumption is a lot of shorts. And if there's a lot of shorts, what do you have to do to cover a short? You have to buy it. That's where the buying comes from to jump price. Shorts are not getting paid by lower price. And if shorts aren't getting paid by lower price, they're building up pressure and it's a lookout above moment. It's just if you could have the sound of a lot of swearing by people selling, if you get a lot of people that are swearing and they're short, a rally's about to come.
Okay.
That's the whole dynamic behind delta divergence.
Who lags first, the euro or the dollar?
Who lags first? Or
yeah, who lags first, the euro or the US dollar?
Well, it depends. I mean, if it depends on what's driving it. So you could sometimes neither one leads anything, but if you have a lot of ECB, whether it's their decision on interest rates, any kind of press conference they're holding, then the euro is going to be more important. If it's our Fed, the dollar is going to be more important. If it's commodities against the currency, it's usually the dollar is going to lead commodities lower. It's not always, A goes up, sell B, but it depends on what the fundamental driver is. Depend which currency would be more important at that point.
Okay. What would lead gold? Correlations seem to change in risk environments as opposed to inflation environments.
Well, yeah, I mean, that's the thing. That's your part and your job is to know what's leading and why and what environment is causing something to be more important. Like I just said, interest rate environment and central bank speak will cause bonds and stocks to sometimes move alike because, and I'll just go over this real quickly, interest rates go up, bond prices have to go down. Interest rates go up, stock prices are like spoiled little brats and they go down. So that's when you get bonds and stocks to correlate the same direction if it's straight interest rate movement or fundamentals that's driving. Gold, for instance, sometimes is a safe haven commodity and it's often opposite to the US dollar. So people will use it as a replacement currency. They'll sell dollars and they'll do well with it, buy gold. Not tick for tick. Now I don't want people to get to assume that, okay, every time dollar goes down, buy gold, but you'll get like a longer time frame. If you get weak dollar, you usually can get stronger commodities, oil, and then gold as they're reallocating out of U.S. dollars into gold. Silver would be an obvious correlation to gold because they're both precious metals, and so what you'll often get in gold is you'll get sometimes gold to rally and look like that, and you'll get silver to come up, come down, and rally and look like that. You see the difference? Where one rallied through that high, and yet the other one, silver, is quite a bit away from that high. And this is a divergence between ancillary markets. This is a head-scratch moment and say, maybe gold is expensive because it usually charts similarly to silver, and it's not right now. So those are a couple ancillaries to gold.
Okay. Do you use COT data to determine your bias for the day, or just use order flow to judge which direction to trade?
Do I use what to determine my bias for the day? What was the first part of that?
COT data?
No, that's like open interest. And no, what I use for my bias of the day would be a mixture of fundamentals and these correlations. So I don't always come in, not always, with a bullish or bearish bias. Sometimes you got to let the game start and adjust to what's going on. I do have an idea who has the torch, so to speak, or who has a better chance of taking it higher or lower. But sometimes that torch gets passed so much during the course of a day, you can't be bullish or bearish all day. So there's a lot of things, and fundamentals are usually going to be the most important if there are fundamentals, like a big number, some central bank stuff. Like early on, Dudley's comments got us weak and kept us weak early in the session. So, for instance, for example, for today, I did have a bias coming in. It was because of fundamentals. So fundamentals will drive my initial bias stronger than anything else, a big number, big fundamental, big geopolitical event, something like that. And and then ancillaries. Like sometimes there's a lot of, here, I'll draw it here. There's a lot of open long positions in that rectangle, and price is going to open up right in here. And if I'm accurate in assuming that there is a lot of long positions down in here, Terry, then it's going to be a magnet. And we're going to open up and we're going to test that area where a lot of longs are opened up. And it's a magnet because what do people who are long have to do? They have to sell it, right, to cover it. And if indeed it starts to get closer to where they bought it, they see their profits diminish. And just like if you're in a trade, every tick closer to your entry, you're getting more anxious and finally say, I'll just sell it. I'll just sell it, just sell it. And if there are indeed a lot of long open positions that are right here, that would create a near-term bearish kind of bias for me coming in. And therefore, I'd look to try to sell it after the open because I think this area would get tested based on that dynamic.
Okay. What is your thoughts on trying to figure out whether those big lots are closing positions versus initiating positions? Do you think if they are closing, they have more, they are as significant since they're not trapped?
You know what? That's a great question, and the answer is there isn't much of a difference. It's buying either way, and I don't blame someone thinking, because there is, like, if you're closing a position, let's say you're closing a short position and there's a big buyer that comes in and it's that X right there I just drew. If the market rallied and then big buying comes in, I'm still interested in whether or not it sent it up, because whether that guy was closing a short position or initiating a long position, it's still buying and it still didn't make the market go up. So I'm not going to know if he's closing it or not. So I'm not going to try to guess, right? I don't know if he's opening or closing it. So I'm just going to say that buying either way should have drove price up because it's buying. And it's the reaction after that buying that's going to allow me to scratch my head or not. So if it doesn't drive it up, I'm going to treat it as if he's closing a position or initiating one.
Okay.
And sometimes, let me add to that, sometimes it's not one order. The way the CME reports data, sometimes it could be 201 lot orders, but they're reported in the same millisecond, so the same dynamic plays out, where it's still a lot of buying and it can't run prices up. So if I'm bearish, that's the when moment to take a shot and get short.
Okay. All right, I'm going to ask this as a last question. Do you have any more in-depth learning recommendations about order flow patterns that they can go to?
You know, I mean, I don't want to, I wasn't here to sell anything or be salesy about it, but you could go to the website that we have, edge.marketdelta.com, or you could go to watch a little bit more of that video when you get a chance to pop that link in there, and just walk through it like that. I try to tell people this, that anytime that you're going to get better at something, you have to create a relationship with whoever you're going to be around and learn from. And it's hard to do that with just faceless webinars or YouTube videos and books and things like that. So you got to leg into what you're understanding, and it has to be simple as to why it might work. And all people are trying to do, and this is all, and I'm just speaking from experience, all I was trying to do was give myself the best chance to do this. And when I was in the pit, and I was 25 years old, I was failing, and I'm thinking, what really bothers me is I know this isn't my best chance at it. If I quit, I'm going to regret a lot. And then I started asking the right question. Who's doing this? What are they doing? Who's doing this? What are they doing? That's how I got introduced that a proprietary firm existed, what that was, and the rest became history. So if I failed at it when I was in the prop firm, I knew I would have given myself the best chance to do it and turn over the right stone. So whether it's our stuff you learn from or other people you learn from and concepts you learn from, remember that trying to learn order flow and trying to learn market relationships are the two pillars in the path you got to go down. And whether you invest in this kind of stuff or any kind of stuff, try to put yourself around people that are like-minded and that you could relate to and with. And that's one of the things we do is create relationships with like-minded people, kind of like a virtual office of traders, because one of the weaknesses is executing. It's because it's such a lonely business, and you think you're lucky when you're right, and you think you suck when you're wrong all the time, and they shouldn't feel like that. There's no way you're going to get consistent. So I encourage people to, no matter where you try to learn more about this stuff, you can learn it from us and go to the website I told you about and watch the video. Terry's going to pop in the chat. But either way, just make sure that it makes sense. There's a dynamic that I could see why this is a skill and why it would work. Because if it's just an indicator that pops up, that's not really a skill. And that's what lazy people do, because they don't want to learn, they don't want to understand, they want something else to do the work for them, and they realize that that's the wrong path. So not to go on and on with this answer, just try to get yourself leg into the understanding, and remember that knowing something doesn't mean you understand it. There's two legs to kind of going through it. And I'm not the smartest guy in the world, but I'm smart enough to know that I'm not, and I'm also smart enough to know that being around other guys is what got me successful, period. It wasn't me. And geographically, I was fortunate because Chicago had a lot of these professional environments around them. Today, people are training from all over the world, and they're not exposed to great environments and communities. So I guess that's the long answer to that, Terry.
All right, sounds good. I have posted the video in the chat, so if you'd like to go to the chat and get that link, you can watch it. It's about 45 minutes long. We'll move over into the book giveaway. Anthony is going to ask 5 questions, and then the first person to get it right wins the book for that question. And then Anthony, you can talk a bit more about the book here.
Yeah, I'll preface the book real quick, and then I'll read the question, and then you tell me when you got your winner, and then we'll go on to the next question, right?
Oh, yep, sounds good.
All right, so the book has nothing to do about trading. It has to do about making decisions, and what it separates, it gets down to that simplicity that I've always talked about. And I had a guy that was a higher-up executive that I met on a vacation. He was a higher-up executive for Ford, and he was retired, and I spent a week with him. We just happened to be down in Florida at the same time, and this is a book he really recommended, because I was like, I don't like to read a lot, so when I read, I like to read a book that I know I'm going to read, and so he said, you got to read this one. He says, because it helps understand. He understood kind of what I did, and he says, this is what you do. It's the simplicity of taking what works and duplicating the hell out of it, instead of trying to be too cute with solutions. So it's change when change is hard, and the mind makes things really hard. Your mind is not wired to be successful at trading. That's why most people who try to trade don't. That's why the sky's the limit once you get it, how much you can pull out of the market. But you're not wired to be successful. Understand that. So you have to rewire yourself in a way that you naturally do it. It becomes less and less effort. I think this book will help, but it's a combination of just trying to keep things simple and let everybody else make the mistake, and then you pounce on it. We eat what we kill as traders. You got to be the predator and not the prey, and you got to know when you are the prey, and you're going to sometimes be the prey, but you got to not just find the herd. You got to see when the herd's about to fall over the cliff and all die. That's what you're looking for. So if you just get in front of herds all day, you're going to get trampled a lot. You see where they're around a cliff and about all to fall over, and that's about being simplistic in your process, and realize that it's the implementation of the right skills is where your success is going to come. So the 5 questions I have, we'll start with the first one. Some are very easy. I think one might be kind of hard. I'll read it, and then people will type it in, and you'll tell me when they get it, Terry?
Yep.
All right, here we go. First question. What market is a good inverted correlation to the E-minis?
All right, Melissa S.
Nice.
All right, give me 1 second. I've got to.
Got it. Melissa.
Okay, if I call your name and you're a winner, please hang around after the webinar so I can get your contact information. Just a little heads up. Okay, we're ready for the next question.
Number 2, if you saw a big buyer and a market's price did not go up, would you want to buy or sell?
Chrissy Robson.
All right, Chrissy, nice job. Paying attention, I like it.
Scroll back. Man. Okay, where'd you go? There she is. Okay, we're ready for number 3.
What is the most important U.S. economic release during the course of a month?
Bam, already. It is Ajib.
All right, nice job.
Please forgive me if I do not pronounce your name correctly. Okay, we're ready for number 4.
This one's kind of difficult, Terry, so they got to listen, all right?
All right.
Because I covered it, but I didn't cover it in it. You got to think it through. Don't jump on it, and it's not easy. So think about it. It's the hardest one of all 5 by far. Now, here we go. It's 2 parts. So here we go. If you're short 10 contracts and buy 15, and now remember, this is 2 parts, so don't jump on the answer. There's 2 parts to it. So if you're short 10 contracts and you buy 15, are you net long or short? And if you wanted to exit that position with a market order, would you look for a bid or an offer? I'll read it again. If you're short 10.
I think we got it.
Oh, nice.
Let's see. You can go ahead and read the question.
The answer.
I think I got the question, though. I've got to scroll through. Yep, Sebastian was the first one with the full price.
That's impressive, Sebastian. Nice job.
The correct answer is long 5, and you're looking to bid.
You got it.
All right.
Some people might say, well, what does that got to do with trading? It's got everything to do with trading. You got to be able to know bids, offers, even if you're not going to trade super fast. It's all about the auction. Last one. You ready?
Yep.
What color are my eyes? No, I'm just joking. What is the number 1 weakness of every trader, pro or retail?
Already, David. Is execution.
You got it.
David Toe. Okay. I'm just scrolling back to make sure I got everyone's name correct with their answer. Okay, it looks good. Okay, can you say the name of the book and the author again? There's a couple people asking about it. I guess they missed it.
Yeah, in fact, I probably can give you the link. They can look at it on Amazon. Those who didn't win probably want to buy it. So let me put that in here. You want me to send it to everyone, or?
Yeah, you can post it in the chat.
Okay.
Yeah,
I got it.
Let's see.
No, I can't. I'll send it to you. You send it to them.
Okay, that's fine.
They won't let me send to the audience. So the book is Switch, Change Things When, I don't even know if that's the subtitle. But he's going to pop in the link. There it is.
Yeah.
That should work. And it's written by 2 brothers, Dan and Chip Heath. I think you'll like it. It's a good book. Let me just summarize one story in there real quick. A guy went over, I think it was to Vietnam, because they were having trouble nourishing kids in a lot of their communities. And so many people before him failed at trying to fix the problem. And they thought it was because they needed jobs and they needed more work and all this other. And so there was a lot of pressure put on him by the government because somebody others had failed. And so he finally, with little resources he had, he tried to find out if there were any pockets of people who weren't malnourished as kids. And he found them. He found small groups, and he just asked what were the mothers doing to feed these kids. What were they doing with limited resources? And he just duplicated the hell out of that, out of what they were doing that was working. And so how do you take that and you allocate it to trading? And it's like, for me, it was who was doing this successfully. Let me duplicate their technique. Not identically, though. And that's the one thing I want to finish this off with is you'll never trade exactly like someone, but you want to understand and think like others that know what they're talking about. So the question you always ask is, does a guy know does he seem like he knows what he's talking about? Yeah, and then you go a little further into your relationship with him. If someone sounds like they're selling you something, yeah, well, they probably are. If someone sounds this way, that way, there's a lot of bad people and a lot of good people out there trying to help. But one thing is, don't try to duplicate someone else. I could tell you where to buy it and sell it, and you'd screw it up. You could tell me where to buy it and sell it, and you'd be dead right, and I could screw it up. So you want to work on those core principles and know, to me, it was what prop guys were doing. I didn't even know what a prop firm was. Then I became one of those guys, and that's what's important. I don't advocate people go out and try to get hired by a prop firm, but if you did, what would they teach you? What would the training be like? That's what you're going to try to duplicate, that kind of training in some respect. So that's all I got, Terry. So I appreciate you guys having me on. I hope everybody enjoyed it. And if you got any questions, they got our information to reach us, I would imagine.
I have been tweeting the MarketDelta Twitter, so I'm assuming they can get in contact with you through the Twitter or the website.
Yeah, that's good. You know, another thing is they could follow us on Periscope through Twitter. I do 1 or 2 updates a day, and they're free, and I just kind of, it's done with my iPhone and the camera over my monitors and talk about what's going on. So go ahead and do that at MarketDelta, and you could kind of stay in touch throughout the day that way also.
All right, perfect. Sounds good. Thank you for today's webinar. Have a great day.
All right, my pleasure, Terry. Take care.